Sorry for the delay. So it's my pleasure in welcoming you all for the 5th session of the series on how to be investment ready, presented by TiE Chennai and Kiritsu Forum. The 5th session is going to be on getting ready for due diligence. With this, let me introduce the speaker of the series How to be Investment Ready, Mr. R. Subramaniamaya, alias Subra. Mr. Subra is a forensic accountant, independent director, angel investor, strategy consultant focusing on business models, and an expert witness with over 30 years of work experience in Asia and Australia, and transaction experience in Asia, Europe, and the US. Mr. Subra is the co-president of Kiritsu Forum, Singapore, and Chennai. Kiritsu Forum is the largest angel network in the world with 53 chapters and over 3,000 accredited investors. In the entrepreneur space, over the last decade, Mr. Subra has played a missionary role in guiding and assisting CEOs of small companies in South India and South Asia through critical growth stages. In India and more broadly Asia, through his other ventures, Subra worked on understanding and addressing the severe shortage of resource in small business sector, from financial capital to experience capital, relationship capital, and infrastructure. He was a partner with the PricewaterhouseCoopers, Singapore, in over 21 years with PwC. Mr. Subra has been an auditor and tax due diligence. And in 21 years with PwC, he led over 100 engagements of various sizes, including my phone just got cut off, sorry. So he has led over 100 engagements of various sizes, including many that were cross-border for US and European multinational operations. He's qualified with Bachelor's in Accountancy from National University of Singapore and thereafter with the Institute of Chartered Accountants in Australia. He's also completed the General Management program at Harvard Business School in the fall of 2007 and is an alumnus of that school. So on behalf of TiE Chennai and the participants here, I welcome you, sir, and invite you to take over the session today. Thank you.
Thanks, Saurav. Thanks. Okay, I think, I hope most of you all have attended some of the other sessions. So, yeah, this is a part of a series of 6 sessions, and to some extent you will begin to see that, one item links with another. So with that, we will just get started. Just a little bit of clarification on the introduction. When I was a partner at PricewaterhouseCoopers, I was an advisory partner, and half of it was spent doing nothing but due diligence, right? So I spent 5 years leading the transactions group, and I did due diligence for a living, right? So this is a topic I kind of understand well. Obviously, mostly with big companies when I was a partner at PwC, but the skills are the same, the thinking is the same, and therefore, apply the same with some modifications when it comes to startups. So with that, let's get moving. Priya, can we have the next slide? Yeah, okay. As Saurav mentioned at the start, this is session 5. So it's we're coming to the end, and I was mentioning to Saurav, the next session is actually kind of heavy because it sort of brings everything together. And I can anticipate a lot of questions when it comes to valuations. So we will talk a bit more about it. We just had to split the sessions. Otherwise, I'd be talking for too long on any one day. But you will see it all come together when you listen to all the 6 sessions, and especially the one next. Okay. So we'll talk about due diligence today. So Priya, the next slide, please. Okay, I have given you the link to the Keiretsu Forum website. Now, there are quite a few videos that you can take a look. You can hear the founder of Keiretsu Forum, which is Randy Williams, having conversations with investors and others about what due diligence is. Now, these videos are kind of long. They could be about 30 minutes long. Therefore, to be honest, I haven't watched them, but I haven't watched them because, as I mentioned earlier, I did due diligence for a living, around the world, including in Switzerland, in New York, and all the kind of things. So it would be kind of boring for me to listen to the whole thing. But for those of y'all who are, coming into this the first time, I think you will find the videos quite informative, right? Of course, I'm covering the key points in this talk, but if you feel you need to understand a bit more, I do encourage you to watch some of the videos, or at least part of those videos. The other thing is, in the same site, there is something called the Due Diligence Handbook. I haven't sent it out because you can just go to the site, click it, and download it. And you should do that because it gives a whole lot of documents, and including in the handbook is some of the things that we will cover in the next session, because it relates to valuations, it relates to transaction documents. So there are sample documents, and how to manage a due diligence is also given in the due diligence handbook. And if you do download it, go take a look at Appendix H, which is the due diligence, which is the Keiretsu Forum due diligence Kickstarter. Some of the officers in Keiretsu actually gets startups to fill that up even before they are accepted, or considered to present at the forum, right? SVK, I don't know whether we use the Kickstarter in Chennai. I mean, I know I don't use it in Singapore, but maybe we do in Chennai.
We are not.
You're not using it, okay. And then I had asked TiE to distribute a subset of the above documents, which should have gone to you as a PDF, which says preparing for due diligence, the Keiretsu Forum process. Obviously, these documents I picked up from, various documents that Keiretsu had sent out. So it is necessarily US centric, but I'm sure when you read it, you can easily translate it to an Indian environment. And hopefully we will cover some of the Indian environment issues as part of this talk, right? So these references are important. I know that on all my talks, I do give out references because I think they are kind of helpful. Okay, with that, next slide, Priya. Okay, next one, just title page. Okay, now why due diligence, right? Which is the question, right? And really the purpose of the due diligence is threefold. The first thing is, before anybody invests in you, the idea is they should make an informed decision, not a rash decision, not a gut decision. And therefore, to have such information, they need more than what you say, right? So some amount of verification needs to take place, right? So the most important objective probably is so that investors can make an informed decision. Because at the end of the day, you would have heard me say during the talks that as an investor, as an angel investor, we all know a third of the money that we put in, we will never see. A third of the money will give us some sort of a middling return, right? Not much more than interest rates. And it's the final third that's going to give us the phenomenal return that enables us to make a reasonable return on the entire portfolio, right? And when we evaluate investments hoping that all of them will give us phenomenal returns, right? Because how else do you decide, right? Because even when you have done a good due diligence or picked a good company, the risk of failure is high with early stage companies. That's just the nature of the beast, right? That's how startups are. So the due diligence process is to help the investors come to a point where they feel comfortable enough to sign a check, okay, and put money into the company. The second objective of the due diligence is, there is a system to the madness. And the whole point of that is, if there is a problem, a real issue, we would like to know sooner rather than later, because even for the company, it minimizes the pain, right? So that there is a problem, and until you fix the problem, nobody will touch you. You'd rather know that sooner rather than later, right? Because it saves time, and sometimes it also saves cost. Okay, so that's another thing that that's another objective of due diligence. And the third objective is, you just become better entrepreneurs going through this process, because you begin to understand, what would be some of the detailed questions that a investor will ask, and perhaps the next time you will be even better prepared, right, for investments, right? So those are the objectives. Yeah. Okay, Priya, next slide. Okay. Now, there are many things that we will cover as part of due diligence, right? And most things are strategic. But there is a set of items which I would call hygiene factors. And what do you mean by hygiene factors? These things must just be there, because if they're not there, then we have a compliance issue, and then you have this whole thing about having to deal with this non-compliance, fixing all these problems. Okay, now what are these compliance or hygiene factors? And really, angel investors would rather not have to spend a lot of time on it. And therefore, and in an Indian environment, I'm not really an expert to talk about it, right? So these are areas where you should actually be talking to your chartered accountant or your company secretary and checking with them if you are in compliance, right? So what are the things that you need to comply with? Yeah, your company registrations, your memorandum and articles should all be done properly, right? And then you have annual filings, all those filings should be done properly, right? You need your PAN, you need your TAN, you need your GST registrations, there are quarterly filings, all of these need to be done. And if you have employees more than a certain number, then you need to comply with the Provident Fund related provisions, including payments. And India being India, it is still license Raj to some extent. There are all kinds of registrations, especially if you're manufacturing something. There are factory permits. I think there are permits for power and all that kind of stuff, right? Now, as I said, given that I'm not an Indian CA, I am a CA from 2 other countries, but not India. This is really an area that you should talk to your local chartered accountant and company secretary, right? These are just compliance that you should be on top of, right? And maybe some of y'all would have heard me chatting with SVK about fintech companies, right? Fintech companies has got another major compliance factor, which is the laws set by the central banks of various countries, right? Because, the problem with startups is, we all want to start something, and then we don't spend enough effort to understand what is the law of the land, right? And sometimes the law of the land is not, is not easily seen, okay? So these are hygiene factors. And usually if you have a problem with your hygiene factors and it is not fixed by the time of the transaction, usually investors get a little bit nervous, right? So this is an area I would encourage you to speak to your local chartered accountant, company secretary, and get them fixed even before, you look to raise money. Okay, next slide, Priya. Okay, so we'll leave out the hygiene factors because and focus on the strategic, right? Which is really where I can add value to today's discussion, right? So think of the due diligence process as various stages, right? The first stage, you should get organized, okay? Now, to help you with this get organized, Priya, did we circulate that document that I asked you all to send them?
Yeah, I did.
Okay, right. So in the document that TiE Chennai has already sent out to you, you will find that there are a lot of documents, a lot of suggestions on how you prepare for due diligence, right? I don't plan to go through that document because they're kind of obvious, but some of these things, what is organization, what's key question, verification. So there's a lot of details that we have already given. And if you look at that document, and you go to the Appendix I, which is called the document binder, it even gives you an idea of what you will incorporate in your deal room, okay? Uh, and I will talk about deal room or data room interchangeably in just a moment. So if you start going and looking at that, it gives you an idea of the things that you should prepare for, okay? So the organization is important, and these are documents that, can kind of help you, right? And as I said, when I ran the transactions group at PwC, this document request list will always go out as soon as we have an engagement to do a due diligence, right? So again, for those of y'all who are new to it, it is a very comprehensive list, and you will probably need, you probably won't have all the documents required, but at least it kind of gives you a guide, right? So I have given out that document, and if someone has questions, I can always take that towards the end, but it is a document to help you with your organization, okay? Right? So there is a document request list, right? Which is what that is, right? Or a part of the document that's sent out is actually a document request list, right? So it kind of helps you prepare and get it all out, PDF it so that it can all be merged into, it can all be deposited in a data room, or what I would refer to today as deal room. So first stage is organization, right? Getting organized. The second stage is, the investor will have some very key questions, some fundamental questions, right? And, and they would want to verify some of these key questions, right? So remember, I said that one of the objectives is to minimize the pain. And quick questions may be things like that. And these are issues we have dealt with, right? You may have a bank loan which may be non-performing. It's a very key question, right? And investors really have to decide upfront, do they even want to touch a company with a non-performing loan, right? So, and if that's a red flag and it's a big issue, the due diligence stop then, right? So no need to go through the rest of the pain, right? So the key questions is fundamental things, right? For example, we do a lot of deep tech companies. So the question is, who owns the intellectual property, right? Because if there is any doubt on the ownership of the intellectual property, then the whole entire investment is moot, right? So the idea is to get into some of the most important factors that would affect your particular company immediately, and verify to see, and verify that, okay? And the verification is done by review of documents plus interviews, right? So first thing is to address the main things, right? Without which, no point going further, okay? So it would be things like, do you have non-performing loans? Do you really own your intellectual property? Do you actually have control over your source codes? Things like that, right? Very, very important things, right? Then we get into what's called a deep dive, which might include visiting the company. You might provide a product demonstration and all that kind of stuff, okay? Right? So first step, key questions, because if there is any red flag, we want to know it sooner rather than later, because a due diligence process can be quite intensive, right? Because, somebody needs to make an investment decision, right? And the due diligence process helps, okay? So then you get into the deep dive. And then, of course, there are reports that are written. In some cases, reports are not written. If it's only a few investors, they might agree, no point putting the whole thing into a report. But often, you as the company, as the entrepreneur, may want a report because you might take it and show it to somebody else, which happens a lot in the Keiretsu world because people raise money from several chapters, and it always helps that they have a due diligence report if they are raising money from several chapters. Okay, and then of course the final stage is the deal closure, and we will talk more about deal closure next week, which is session 6. So we'll talk about documentation, what are term sheets, what are some of the value decisions that go into it. Okay, Priya, next slide. Okay. So we can break due diligence into several types, okay? Right, and I will try and go through all the various types so you kind of know what you should prepare yourself for. Okay, the first is what I would loosely call management due diligence, right? So the investor wants to do some checks about the entrepreneurs, okay? So, you know, we may want to interview your professor, your previous employer that you work with. And these are hygiene things, right? To just find out, especially if they don't know you, right? If they know you, right, which happens in a small place. I mean, if you're from Chennai, the investors are from Chennai, you know, they would easily know your background, who you work, where you studied, and all that kind of thing, right? And the reason for the background check is, you know, this is the whole investment process is about trust, right? Can I trust the team? Okay. So it's a little bit of background checks. And when we do due diligence, we do take it seriously, you know, who you work for, you know, can I at least ask a few questions, right? Particularly if there is a red flag, we want to know very quickly, right? And if you remember in the first session, I talked about, you know, having a team and whether the team is compatible. And I also touched briefly on what I would call emotional quotient, because we have had experience where the teams break up as soon as the going gets tough, right? So to some extent, we want to make an assessment of all of this, right? So this management duty can also be a combination of HR duty, right? Looking at the human resource structure, whether this team can actually go through the process, right? As I said in the first session, you could have a powerful single founder. It works, but nobody can deliver a company singly, right? So they would need at least a team somewhere behind that can support and deliver on the expectations, right? So one due diligence is management due diligence. So you can just imagine that, you know, some of these questions can be quite intrusive, right? And personal. And this is something that you do need to prepare for if you want to raise money from other people, right? It's not just that people give you because you asked for it, right? It doesn't happen that way, right? People want some assurance that they can at least trust the entrepreneur team to not do the wrong things. And the reality is because these things have happened. There is a fairly substantial Keiretsu Forum deal. I don't think anyone in Chennai or Singapore invested in that particular deal, but they raised quite a bit of money in the US and Canada. Maybe those were the countries. I'm not sure if they raised any money in Europe. And the entrepreneur ended up being a fraud, right? So it does happen, right? So people want to be a little bit cautious, you know, before they actually put money in the company, right? So one thing to expect is some intrusive questions, which I am broadly categorizing as management due diligence. Then there is the legal and secretarial due diligence. To some extent, I talked about it earlier as hygiene factors. Now, very often, this due diligence is outsourced, especially in a place like India, because you know, company secretaries are a profession in itself in India. And because Indian laws can be kind of complex, right? Especially if you have factory norms that you need to comply with, you know, we would rather let the experts do it, right? We are lay people. We understand strategy. We understand go-to-market. We understand marketing. So we might understand the business, but understanding law is kind of difficult for us. So often this aspect does get outsourced, and very often a company secretary will end up doing it. A chartered accountant or company secretary will end up doing it, right? So you also have to remember that once the due diligence process, there are some costs that the company or the entrepreneur needs to bear, right? Which will be some of these things, right? Especially the portions of the due diligence that might be outsourced. And clearly, legal and secretarial is something that can be outsourced. In my mind, the third and a little bit of the fourth is perhaps the most important diligence that one needs to associate with startups, right? So I would call them loosely market and commercial due diligence. It is how attractive is the market in which the company is going to operate? What is its position, right? So including an assessment of its competitive positioning, we would want to assess. And we also want to get a feel as to what the go-to-market plan is, right? And if you think about it, for a startup, this is more important than the last bit, which is the financial due diligence. Because nobody really knows what your finances are. You almost have no history, right? So it's very difficult to do a financial due diligence, unlike big companies, right? With big companies, I mean, what I used to lead is really financial due diligence, because markets are mature. So the market and commercial aspects are already incorporated into many years of historical financial data. A startup doesn't have too much of a financial history, and therefore a lot of time actually gets spent on market and commercial due diligence. And I have a slide that goes into it in a little bit more detail. Then, of course, technical, operational, and IP, which stands for intellectual property due diligence. Now, what one does here really depends on the industry. And ideally, someone in the due diligence team should have some industrial experience or some experience in that particular sector, which helps with the due diligence, right? And then, of course, the last is the financial due diligence. As I said, you really don't have that much of a financial history. So generally, it's an assessment of the financial model, right? And it's really impossible to assess the financial model if you don't understand the operational constraints, if you don't understand the market opportunity. The financial model is as good as a spreadsheet exercise, right? And often it is, right? Many of the models that companies present to us are a pure spreadsheet exercise. And the assumptions that go into it don't really match well with the market positioning or the operational constraints, right? So that becomes an extremely important thing. So a lot of time can get spent in trying to get that sorted out. Okay, next slide, Priya. Okay, now this slide actually comes directly from the previous session, and I've just included here just to remind you that, you know, once you get into due diligence, there's a lot of confidential, or there may be a lot of confidential information that may begin to be exchanged, right? So remember, if it's people that you completely don't know, make sure that an NDA is signed. You know, is just good discipline to do it, right? So I'm not going to go back into NDA because I spoke about it at the last session. So Priya, next slide. Okay, I'd like to spend a bit of time on, there are many ways in which you can do a market and commercial due diligence, right? The common ways, you know, for those of you all who are familiar with management talk, Michael Porter's 5 forces analysis, who's your customer, who's your supplier, what are the alternatives, okay, what's the other one on top, and then what is the competitive positioning, right? I mean, you would have heard very often where I would have talked about, even when I discussed business models 2 sessions ago, are you in a competitive space, right? And there are many startups in a competitive space. Not that you can't win in a competitive space, but it becomes a little bit more difficult to assess whether you will be the winner, right? So e-commerce is a space like that. Edutech has also become a space like that. So one needs to get into the details to see what is the market positioning or the competitive positioning, right? And Michael Porter's tool is kind of useful for that. Other tools that they would use, a SWOT analysis, right? Strengths, weaknesses, opportunities, threats. Sort of look at the company and sort of say, okay, how do I position this? And what are some of the issues, right? Or the potential issues. So these are some tools that I use. That there are a myriad number of tools. I just highlighted this too because I tend to use them a lot. So it's a bit of a personal favorite of mine. And certainly with bigger companies, they lend themselves naturally. Sometimes with some of early stage companies, it's a little harder, but we kind of use principles of these tools as I have spoken about business models, your competitive position, is your value proposition really better than other people in that particular segment, right? So it's coming to the same thing, right? The other bit is the market side of the due diligence, which is really your GTM, right? And GTM stands for go to market, right? And if you remember, we talked about customer segmentation, channel decisions. I covered them in session 3, right? Which is my business model discussions. And we also need to know whether you can actually execute on it, right? Which is the execution capabilities of the team, right? And we talked about that in session 1, because sometimes, you may be technically extremely competent, but you just don't have someone in the team who's got the gift to face the market, right? Because facing the market is not easy, right? And if you all remember the video, the Bill Gross video in session 1, it's like, going facing the market is like getting punched in the face, right? Because that's how hard it is to sell something that is innovative, novel, and new. Okay, so a key part of the market and commercial due diligence is really assessing your go-to-market plan, right? Which is really your execution, right? So these things is an area where you can expect someone doing a due diligence to spend a lot of time, right? So it helps if you have thought about it and you have prepared for it before someone is coming and taking a look at that. Okay, the next slide. Okay, right? So now that we've sort of looked at what are the various aspects of due diligence, right? The question is, how do you get organized, okay? So you have, the document I've shared earlier, which sort of tells you what are the things that goes into the binder. So even before someone is going to start a due diligence, right? The first thing you want to do is get all your documents together, right? Get all your documents together. And you want to be, so, PDF it or whatever it is, right? And you want to place all these documents in what I am describing as a secure document repository. Okay. Now, if you look at if you download the due diligence handbook, I think this version talks about Procedure as the tool that Keiretsu Forum use. That's what the US uses. In Chennai, we used a system called Gust, right? So we create a deal room where you can post all of these documents, right? It's called deal room. Many people call it the data room. In the old days, I used to call it data room. So they're used interchangeably. And the idea is only certain authorized people can go in and view those documents, right? And many of these secure repositories are such that they can view the document, but they cannot download anything, right? So there are all these kinds of systems available, and you make a decision based on how important those documents are. You can have the required security to go with it, right? And in Keiretsu Chennai, we manage it by creating the document repository under the deal room using the system that we use, which is Gust. And it's not specific. I mean, you can even create a Dropbox with a password, and that works just as well. Okay. Now, the thing is, when you set it up first, you will find that as the interviewers ask questions, right? As I said, key questions followed by deep dive, you find that more and more questions get asked. And to respond to it, you create supplementary documents or you create questions and answers. Now, it makes sense that you also deposit them into your deal room, right? Because The next time somebody is doing a due diligence, let them read that rather than go through this whole email exchange between the reviewer and the company, right? So as supplementary documents are created, the idea is go and put it in your secure repository. Of course, once you have created that repository, you should know who you're giving access to, right? And again, there I go to the NDA, who are your reviewers. So you create the kind of controls, and generally it works because people in this business are usually respectful of the need to be, the need to be, to comply with confidentiality, right? Because is your key interest, right? Obviously, you will never put things like source codes and stuff into your document repository. That's really not required. That's really very important intellectual property. So you're not going to expose things like that, right? So this is going to be more like agreements, contracts, projections, assumptions supporting your projections, maybe some information about customers, contracts with customers, customer orders, things like that are the kind of things that it's more likely to get into the deal room or the data room. Okay, so the first thing before you get into a due diligence, you need to get organized. Okay, next slide. Next slide, Priya. Okay, next you need to get ready for the verification, right? And the verification would involve reviewing these documents, probably a site visit. The reviewers want to visit your office, and they would want to meet not just you, but also your team, right? Because, they're making an assessment. Remember I said management due diligence, HR due diligence, right? People want to gain comfort that you actually have a team that can execute on it, right? So instead of just talking to one person, they want to talk to a number of people, right? That's the way they kind of gain assurance, right? How does the team relate to the leader and things like that, right? So there will be a site visit, right? And they want to talk to not just you, but they also want to talk to key members of your team, right? Not necessarily anybody and everybody, but they want to speak to really some of the key members of your team. As I said, we do a lot of deep tech companies, so often there is a product demonstration, right? So if someone is visiting your site, you should be prepared for a product demonstration, right? Especially if you've got an infrastructure tool, right? You've got an underwater ROV or something like that. You actually want to be able to demonstrate it and show what it's capable of, right? Because that's what impresses people, right? Or if you have anyway, if you have a device, people want to see how the device works, right? If you are selling candies, people want to taste taste it to see, is it really so good, right? So there's always a need for product demonstration as part of the due diligence. Now, the third thing is industry research, right? It kind of helps if you have done some of this industry research yourself, because if you have not done, the reviewer will often want to check out the industry, especially in the area of startups, because often we are in an emerging space, especially if you have something innovative, it's kind of emerging, right? So, it's not easy to predict how the market would do, how it would evolve, right? So it kind of helps if there is research that supports it. If you are in the healthcare space, if you have medical journals that support some of your innovation, it's good that you collate it even before the due diligence starts, right? It just makes the due diligence process less painful, okay? Then, of course, there will be verification, right? And verification is what? It's a review of documents and really interview with customers. And if you have a significant partner, then, the potential investors would also want to interview your partners. Okay, so that's how they gain comfort, right? Because early stage companies, there's nothing much in your financials that can give comfort to the investor, right? So they're going to do a lot of detail work by talking to a bunch of people. Okay, now during a due diligence process, right, if at any time reviewers get the feeling that you are not wholly truthful, you can consider it the end of the due diligence and the end of the deal, right? And to be honest, we have done it. We have stopped due diligence halfway down because the due diligence lead said that, look, I can't trust some of the answers that we are getting, right? Because, startups are a bit like that, right? I mean, the least is, we know that not every business idea will succeed, but the least that we want to have is an honest entrepreneur, right? So that when he has a problem, he tells you he's got a problem, right? Not wait till we discover something and by that time it's all a wasted investment, right? So remember, this is a big red flag. Once trust is lost, forget about it, right? We have done it at Kiritsu, and then of course the entrepreneur writes some nasty mails to us, which we will duly ignore, and after a while it will stop anyway, right? Because it's the nature of the beast. If someone's been dishonest with us, what's there to stop the person being dishonest with somebody else, right? You get caught out anyway, right? And it's a little bit of a smallish market, right? I mean, you can, especially when it comes to angel groups and the VC circuit, it's a smallish market, right? If something has happened, the news kind of gets around, right? Even though people sign NDAs, all right, really bad news, really red flags, the news kind of gets around, right? Maybe not about the specific person, but sort of specific ideas. People are always exchanging information, right? That's how they do due diligence. One of which is just being knowledgeable about what's happening in that space, okay? So you need to be extremely careful and be really, if you're not sure, you're not sure, right? Don't start guessing and then get caught out, right? Because you can kiss the deal goodbye if that happens. Okay. Next slide, I think is my last slide before we get to questions, right? Now, as I've just described, due diligence is kind of an intensive process. It's a very personal process. It can be an intrusive process. So it makes sense that even before you get to the due diligence, at least some of the deal terms, right? A broad valuation range is directionally agreed, right? Whether you're doing a convertible, whether you're doing an equity, whether you're doing a safe note, it makes sense that some of the key deal terms are agreed upfront, because otherwise, both the reviewer and you as the company would have wasted a lot of time, and you may have actually wasted some money getting some aspects of the due diligence externally done, especially some of the hygiene factors. You may have engaged a chartered accountant, a company secretarial firm, and and to have done all that and and spend a lot of time on due diligence, and then it all goes to waste because we can't close the deal because the deal terms are just so far apart that it's no longer negotiable, right? So it makes sense. Even before you start a due diligence, we get some of the deal terms fixed, right? And we will talk about what are some of the deal terms. What is a pre-money valuation, post-money valuation, and we'll talk about it in the next session, right? Because this all goes towards valuations and, of course, the transaction documents. Okay, so it makes sense if you can do that before the session. Now, the due diligence itself could be various separate reports, because the reviewer might have an expert on human resource to do the management and HR due diligence, someone with a financial background to review the financial model, someone in the industry to look at the commercial and market due diligence, and someone maybe with a legal background to look at the particularly intellectual property. And maybe someone who's with the industry experience will look at the commercial thing. So what can happen is many of these due diligence reports can be done by different members of the investor group, right? Someone who has the appropriate expertise, and then it needs to be all pulled together into a single document that can be shared around with all the potential investors. Now, if the due diligence is outsourced, and there are outsourced providers, even in Chennai, whom Kiritsu Forum Chennai works with, in which case you may find that you may only have two reports, one on the hygiene factors, another one covering all other aspects of the company, and it's all in a single due diligence report, right? Certainly, if you are at the stage where you are raising money from venture capital, often there is an external party that does the due diligence, right? And the venture and the VC firm will have a few identified people in their panel that you can choose from, in which case you'll have a single due diligence. And what happens once the due diligence is done is you lead to what's called a term sheet. And again, I will talk about what is the term sheet and what is the definitive agreement in the session next week, right? Which brings the valuation and transaction issues to a close. Okay, I think that's my last slide, Priya. Yeah. Okay, so let me look at what are the questions you have posted in the chat box. Okay, if we start, yes, good evening, good evening. Can someone share the document link? Right, those of you all who missed it, I'm sure you can get it from TiE, the document that I've sent out. Oh, okay, someone has posted it. And you can go to the link that I have given in the presentation. And I think after the session, TiE will also distribute it. Right, so the question, what do you look for in emotional quotient? How do you assess it? I can tell you, you assess it because of experience. Now, what are we looking for, right? So one of the deals that we did was a very interesting thing. And it kind of also leads to my point about an operational decision. Now, these companies created a vehicle which, which was more efficient in how you used battery power. It was more efficient. It's easier for someone. It was a if you like, a battery assisted cycle, if you like. Okay. Now, and when they designed it, they initially designed it for internal use, meaning not for on-road use, but to be used in large factories where you basically don't need an RTO permit to run the vehicle. Okay. So it was designed in such a way that it optimized the technology, and therefore it was a particular width, right? I can't remember exactly what the width was. Now, as the business evolved, they realized that that particular market was not big enough. It was not picking up it, and they had to change it for an on-road use, okay? And what we did not pick up during the due diligence is that an on-road vehicle of that size had to be some 20 centimeters, was supposed to have an axle width, which is some 20 centimeters less, right? And without that, you will never get an RTO permit, right? So sometimes this is where, the operational due diligence is important, right? You don't just look at the business as it is. You also need to think of the business as what are some of the alternatives that you may need to consider. And those are things to consider as part of the operational due diligence. Now, the reason I talked about that is to go back to the question about emotional quotient, because what happened in this company was that the founders fell apart. Once the going got tough, the founders fell apart. So how does one assess this, right? And one of the assessments comes, and which is why we don't just interview one person, right? We interview one person, we interview the other person, you then interview them together, right? And believe it or not, even at the earliest time when we were interviewing them, you find that on many technical matters or many specific difficult deal matters that the founders used to fight with each other, right? Obviously, one person will eventually give in and the deal move forward. But the fact that, there were many things that they couldn't agree on from the outset was the red flag that we should have noticed and addressed this issue early on, right? In any case, because this is a startup and there were a lot of mentors and one of the founders reached out to the mentors, we were able to sort it out, and one of the founder left, and the business is actually moving forward in some shape or form now, right? So these things happen. This is not an isolated case. I think we have had other companies with founder issues, and then one group of founders don't agree with another one, and then there's a fight over who owns the intellectual property. So these are the things that we are trying to avoid, right? So that's what I'm looking for in emotional quotient. Whether there's a team, there's another deal we looked at in Singapore. It was in the blockchain space, and the founder was an Italian living in Bali, of all places, right? But he was the brains behind it. He was very well versed with blockchain, um, and he partnered with an aggressive Chinese, probably a Singaporean Chinese, not Chinese, and they're all different. If you understand international cultures, they're all different, right? Just like, you know, we look at people from different parts of India differently, right? A Chinese is different from a Singaporean Chinese, right? And if you, right, they're not always different, there are always exceptions to the rule, but there are certain things that you look out for. And therefore the investor team was kind of concerned whether this laid back Italian can really work with this aggressive Chinese, or they're going to fight the first moment there is trouble, right? So these are things that we kind of get experience with, and so we look out for when it comes to emotional quotient, right? So how to assess it? It comes from a lot of experience and history of what's gone on. What are some of the ways a startup can validate an overseas VC angel, especially if they are not well renowned? Should we ask for any specific? Okay, so I can give you an example of what one of our investee companies did. Okay, so one of the investee companies that we have invested in Keiretsu, Chennai, now has an offer for a particular deal from a party in Thailand, all right? So what did they do, right? So they obviously approached me because, you know, I come from this part of the world, right? So they approached me and said, what do you know about them? First thing they did is obviously they went into the web, they researched the company, they found out their background, they kind of understood what are the businesses that they have, right? After which, based on all of that research, you know, the company wrote to me because I'm also an investor in that company, and sort of said, you know, what do you think, right? So I said, it's Thailand, it's not really Singapore. So let me check with someone I know in Thailand, right? And the person I knew in Thailand was kind of well connected in that market because he is distantly related to the royal family. So he then came back to me and said, look, I know this person individually, you can trust him. There are no bad things about him, right? So the first thing that you do is you make inquiries of people who are likely to be able to get some, you know, some private information of the overseas VC or angel, right? Right. Besides doing your first research on the web, right, and finding out whatever you can on the web, right? The second level is, you know, as I said, you know, management due diligence, right? So background checks, right? Someone who can actually do a proper background check for you. And the third thing is, before you actually sign the deal, right, you engage local lawyers who are trustworthy, right, before you actually sign a deal, right? This wasn't a small deal. This was a huge deal. It was a US $2 million deal. So it is right that people put in serious effort before they do it, right? If it's small amounts of money, it's a question of how did you raise it? Are you just raising it from all in sundry, or, you know, or what our many of our portfolio companies do, which is they go from one Keiretsu chapter to another, right? So at least they kind of know that there is a link between the chapters and they can trust the people who are involved, right? So that's another way of making sure that the overseas investor is someone you can trust. Can you explain the go-to-market a bit more? So the go-to-market, you know, it kind of links to what we talked about in customer segmentation, right? Basically, what is your business, right? You have a value proposition, right? You have an offer, right? And the value proposition is, it is the best thing ever. It is a new thing, whatever it is, right? What we've talked about in session 3. And then there is a market segment, right? There is a segment of the market that will buy this, okay? So have you identified the market segment? Do you have people who can approach that particular market segment? How are you going to sell to them? Are there people in your team with selling experience? These are the kind of questions that people would ask about your go-to-market plan. Okay. Now, because customers don't just come, right? I mean, there's a lot of effort that is involved in getting you customers, right? So, for example, if you're in the electricity space, are you planning to hire someone who already has experience doing sales in that segment, right? So these things become part of your go-to-market plan, right? So it is a fairly detailed plan on how you are going to acquire customers, right? And you may acquire customers um, through the web, through scrolling the web and marketing on the internet. I mean, it could be n number of things, right? Or optimizing your search engine, whatever, right? Those are all part of your go-to-market plans, right? Basically, the question there is how are you actually going to make those sales is your go-to-market. Um, why is some part of due diligence like background checks done at the start? Um, oh, why are some due diligence not done at the start? I mean, it's a question of how much you can do even before the company presents, right? If I can predict who's a fraudster right up front, it would be great, right? I mean, the thing is, most of the time, we always say the best pitch at Kiritsu Forum is a company who's recommended by another member who's already invested in them, right? And that's often the best, right? Because I don't have to worry about background checks that much, right? We know someone who knows them well. And to be honest, many of the investments we've done in Kiritsu Chennai is a bit like that, right? Because the companies have been mentored by our members or people our members know, right? So actually, to the extent possible, background checks are often done very early. So some of the companies, we never did a serious background check, but there are companies that we don't really know, right? It comes from Delhi, it comes from Bangalore. Um, somebody might have recommended it them, and we don't know enough about their background. I mean, if it's people from Chennai, Tamil Nadu, often somebody knows somebody, right? And you're close enough, and therefore the background check is automatically done. But sometimes you do have to do it, right? Because it wasn't possible, right? And until um, we get serious about the investment, we don't actually have the time to spend. How do we do due diligence on the investor's background, whether the money is legally earned? Yeah. So if you are taking money from anybody or everybody, then it's a problem to check, right? So if you're going to angel groups, whether in Tamil Nadu, whether it's Kiritsu, whether it's Chennai Angels, right? You often know who are the members of such an organization, right? So many of our members are ex-CEOs, successful entrepreneurs. So just based on the background, you kind of know that the money is legal, right? It's tax paid anyway, right? And they're not going to put it as cash. They will only do a wire transfer or they will issue a check. And all the information, their PAN and all the kind of thing gets into the transaction documents. So that's how you do, that gives you assurance on the background of the investors, right? It depends on who you're raising money from. Now, when it comes to venture capital, a lot of information are there. There is a licensing regime for venture capital. In India, SEBI does the licensing. In Singapore, the MAS, the Monetary Authorities of Singapore, does the licensing. So you can tell from if they are licensed, then they are probably safer. The dodgy ones will be, in jurisdictions with a weak legal environment, right? Those things that you need to be careful. In India, people generally were comfortable with money coming from Singapore, fairly comfortable with money coming from Mauritius because a lot of the big VCs had structures, and then they get suspicious if it's money coming from Cyprus, right? So many of us kind of know where is the problem and where is not the problem. And as I said, your first money you're taking from friends and family anyway, right? So as you evolve, you identify the established angel groups. The only challenge is when you take money from individual angels and you don't know who they are, right? I'm not here to tell you you shouldn't take the money, but it's sometimes the money is needed just to get you to the next point. But you should be wise and think about the risk that you're taking when you take that kind of money. And the reality is there's a lot of that floating around in India, so it becomes a way of life. Okay, other questions? Right, anyone got your hands up? Yeah, Jawahar.
Sir, good evening, sir.
Hi.
Sir, yeah. Sir, how are you, sir?
Good.
Yeah, sir, in relation to my previous question, it's just in the worst case scenario, right? See, you talked about money coming from Cyprus or, coming from, a country where there is so much of terrorism and things like that, right? So,
Yeah.
in order to do a due diligence on that person who is sitting in a foreign country, how is it possible for us to know, what's his background, whether that money is, properly channeled or, properly earned, and,
Yeah.
it's kind of due diligence for a person sitting in another country is kind of very difficult for a person sitting in India, right? So how do we?
That's right. But in the first instance, as a startup, why are you looking at foreign money? I mean, your first source of funds should be local money, right?
Okay.
Closer to you, right? And you're more likely to raise it. And therefore, when you begin to look at foreign money, as some of our companies have done so, some of the Keiretsu portfolio companies have done so, is at a time when they have matured and expanded their business abroad, right? Then they look at foreign money. But by the time they already have a panel of investors, right? So in the case of the example that I gave, they reached out to me to find out, to do a background check of this particular company and individual in Thailand, right? And I draw on my network to at least make the initial checks. And of course, it's a $2 million deal. So therefore, before they actually take the money, you will actually have lawyers involved, right? And I've recommended Baker and McKenzie in Bangkok to them because I have used them on another deal, right? So when it's big enough, you can do all the checks that you want, right? But your initial funds, you should raise something closer to you so that you don't have to put in all this effort to check the source of the funds.
Subra, I joined. See,
Yeah.
the thing is, you remember PiE, they wanted some money after the second round or third round, and they went through a lot of RBI issues when they got the foreign money. It's not, you don't want to get into foreign money during the initial stages of startup.
Yeah.
It is a very time consuming and procedural thing. And, by the time you're able to enjoy the money, it will be a big thing.
So any foreign money that needs to come in, so we have to inform RBI, everything is routed through RBI, right?
Yes. Only if they want to repatriate the money back to them when the sale happens or when for anything, it has to go through RBI.
Yeah.
Oh. Okay.
And many of our companies, even in their first round, have raised money, but they've always done it through the Keiretsu chapters.
Chapters, yes.
Yeah. So then there has never been any issue, right?
Okay.
It's just a procedural filing with RBI. That's all.
Okay.
Okay.
Thank you.
Arun, you have a question?
Thank you.
Yeah, able to hear me, sir?
Yeah.
I think I have a question on the same funding only. I think in India, I approached. I think based on the networking, I approached. I think two CAs. I think I'm just sorry to quote. I think there's no offense there. Two CAs. I think they are kind of interesting to take some funding in debt. Okay, so one CA firm, he said he has a lot of clients who are interested to invest in the startups, and he said, I asked for 4 crore, and they wanted to have an interest. I think it's on debt, but they are funding for even for servicing the interest also, which means for 3 years, for 1.5 years, you can serve it. I think they are giving for 5.5 crores or something like that. Or what kind of motive is behind this one? Are they likely a right one or not a good one? So
Okay,
I just got.
I don't know whether the laws have changed. SVK can remind me, but I thought only
Yeah.
directors can give debt to companies.
Yes. Loans cannot be taken from outsiders if they are not directors of the company.
Yeah.
Or they should be shareholders.
Yeah.
So,
So
you cannot,
yeah.
Okay.
So
unless it is a bank loan.
yeah.
Okay, got it.
Yeah. It's
Individual loans cannot
probably
happen.
yeah. Right. And in the rest of the world, and certainly in Singapore, you can take debt from others, right? And many investment instruments are convertible debts, right? So it's in India, it's a particular problem, but outside, it's not an issue. But even when you do that, you know, it should be properly contracted. You know, I mean, if you're an early stage company, you know, the risk of debt is the same as the risk of equity. You know.
Yes.
Right. So, I mean, I don't know why an early stage company will actually raise debt. It's very difficult. How do you service it? You don't even know your future cash flow. You don't even know when you're going to make your next sale.
True.
So debts are very difficult to service, right? So why somebody
So the
wants
cost
to
of debt for startups is pretty high generally.
Yeah, it's the same. Yeah, it's high.
That's right. I think for SVK, for your purpose, I think there are, since I got this kind of interest, I just want to push it since we are already experts there, because it's coming from the other side. I think the CAs, they wanted to even give the money, even to serve the interest also for the first 1.5
That's
years.
right. It's like getting deeper into debt, right?
That's right. Yeah.
It's like vaddi போடுறது கந்த வட்டி மாதிரி ஆயிடுது.
That's right.
So you
Now
get
I
stuck
came to know.
into
I think I think a startup cannot take a debt from outsiders. I think
yeah,
this
that
is
is if the CA does not. I mean, if he's going to push for that, there's some other motive behind it. So be careful.
But all the CAs in India knows about this, right?
Yeah. For
It's the
limited
law, I
companies,
think
they
it's the
better
law.
know. So that's why if they do not know, then you don't take money from them.
That's nice. Okay, I didn't go for it, but yeah. Thank you. Yeah.
Other questions? We still have another 20 minutes. Okay, now did anything? Yep. And just to clarify, it doesn't mean you can't take foreign money, but you just need to know how you file it with RBI.
Yeah, that is procedurally you have to be perfect. Otherwise, you don't want to get into legal issues. And RBI are very, very strict on this.
Sir,
You know, in India in particular is a big issue because you have capital controls, right? And it was a huge learning experience for me for having come from Singapore, where it's a country that has got no capital controls. You know, money can easily flow in and out. But in India, you have all kinds of FEMA issues and all that kind of thing. And that's the last thing you need, you know, very early on in your business.
And there are some issues if you want to, if you're a fintech company and you want to get money from foreign sources, the percentage level should be pegged. And if it increases, you have to get RBI permission anyways, even before you need to get the money in. I think it is 3% or 5% or something.
Okay.
For fintech companies. So they want to restrict foreign money into those companies. So there are lots of procedural things with RBI with service foreign monies into subscription.
So for your company, you're saying you have some chapters in India where this is going to be out and out an Indian money?
Sorry?
For your investments, so for your investments,
yeah.
For your company, you're saying all the money is going to come within India. I mean, the investors are going to be within India.
No. I see. For example, some of our companies, which are Chennai companies, they present in Chennai and they have investors in Chennai. They then come to Singapore. They present at the Singapore Kiritsu Forum, and there may be Singapore investors who invest in them. Right. So they're going from one Kiritsu chapter to another chapter. At least you have an introduction, right? because you already know, say, the Chennai chapter, and the Chennai president will introduce you to another chapter. So that way you can gain some comfort that the investors are legitimate. That's all I'm saying.
I mean, the due diligence is taken care by the home chapter, which is the Chennai chapter.
No, but if the Singapore chapter decides to invest, then it has to go through RBI, right?
Yeah.
Yes.
Those formalities are the same.
Okay.
Yeah. So again, it's not the Singapore chapter that's investing, it's the members of the Singapore chapter that's investing.
Yeah.
And the members need to provide certain details, So for a lot of these, in fact, in India, it's become so much of a pain that some of the Singapore investors don't want to invest now, because they say so much of the reporting is quite extreme in India.
Yeah, individual investors are not doing it. They are rare.
Yeah, I mean, they do it sometimes because they like the company, but it is, some of these regulation can become too much as well. And people will say, why do I need to go through this hassle, right? As it is, I'm taking a big risk with early stage companies. Why do I need to answer 100 questions from RBI? So that's also happening. See, at the end of the day, everything needs to be balanced, right? If any country pushes it too far, then nothing will happen.
Yeah, I think, sir, that is one of the reasons is because of terror money that is flowing into India. So RBI is taking a very stringent view in this subject. I believe this is based on what I read, and also they are very careful about countries like Chinese companies investing in India at this present scenario.
Yeah, that is now blocked. It has to go through a special committee to get it approved.
Yeah.
Companies, countries which do not share land borders, which share land borders with India and which do not share land borders, there are no specific rules for investment, basically targeting China.
Oh, okay. Sir, since we have time, can I ask you a couple of questions?
Sure, go ahead.
Okay. Sir, you talked about this deal room, right? There is a software called GUS, G-U-S, you said?
Yeah, GUST. G-U-S-T.
Oh, so how is it different from, Google Drive or anything, I just want to understand,
GUST is a platform which has all the details of the companies, the investments, the investors and all that. They share all documents through that platform. It is just cannot, unless you are part of the group which is involved in GUST, you cannot just log into GUST.
Oh.
You should either be an investor or you should be an entrepreneur.
Yeah, so it's a bit of a walled garden.
Where all this, the entire group is part of the GUST.
Okay.
That's
so it's a bit of a walled garden.
Yeah.
Okay, somebody asked the question whether you can see a sample due diligence report. Let me see if I have one.
No, but the sample, the due diligence reports are, you can just Google it. You have lots of reports available on the web. Because whatever due diligence reports we have, will have confidential information which might not be able to be shared.
No, I can't give out, but I may be able to show.
Yeah.
Okay, let me see. Let me share screen. How do I?
You want? I'll check up whether I have something.
I have found, so I just need to decide how to share it. Let me open the file first. I have a draft due diligence report that is kind of old. It's 2016.
I think I have the latest for.
No, okay. At least this is a company that. Okay, let me share screen.
I can give the Detect Technologies DD report. Fabed's DD report is also available with me, Subra. 2018.
Yeah, but Fabheads is a Indian company, so I'm just. See, I've never shared screen, so I'm having trouble.
So on the bottom, you'll be able to see a green button.
Yeah, I share screen that, and then how do I find the file?
First you open the file and then share the screen.
Yeah.
See,
Maybe
the
that's how
problem
you
is
should.
I've got 100 things open, no?
No, let me see. I'll see whether I can share this Fabbits.
1 minute, sir. I'll just give you the code.
Shall I share the Fabbits? Subra?
Yeah, you can share screen.
Pip, can you see?
Yeah,
Guys?
yeah. So you can just go through it. Yeah, you can just scroll. So this is a due diligence, sample due diligence report. So about the report, okay, who did that report, right? Which
Rana,
is
Rana.
investors. Rana did the
Yeah.
due diligence.
And this has
And,
a table of content which has
yeah.
the full details about what it contains page wise. So
Yeah.
if you look at the content, these are all the things which the report should have. See, first is the executive summary, the company overview, the market and competition, the product, operations and manufacturing,
Yeah.
and then the management and everything. So
Yep.
the
And then go
details
to
are
market.
available
You
in
can
each.
tell what I talked about, go to market.
See, then the
Okay, SWOT
shareholding
analysis.
pattern, the SWOT analysis, the financials, and the risks.
Okay.
So these all this on a whole gives the investor whether the information whether he should invest or not.
Yeah. Okay. So that gives you an idea. Let's keep
You're
the
okay with that?
details
I'm just
confidential.
getting it off.
Yeah.
Stop sharing.
Take it off. Okay. Let me see. So who will bear the cost of the DD? Whoever's raising the money at the end of the day, right? If you want to raise money, that you will often bear the cost of the DD, right? Which is why, if the company is really early stage, only the compliance duty, we get the company to bear the cost and the members do the other duty. If the deal breaks in the middle of the process, well, it's whatever deal you have struck with the investor, whether you share 50-50 or you bear the cost or the investor bears the cost, is what you agree upfront, right? By and large, the companies bear most of the cost of the duty, right? Which is also the reason why if there are going to be red flags, we want to identify it early so that, we're not too far on. So some of the ways in which we help companies manage costs at Keiretsu Chennai is we've got specific providers, and they can be quite understanding because they get such a volume of work. Sometimes they are prepared to waive their fee with some companies. Usually what's the DD cost? I don't know. SVK, do you know what is the DD cost? When we have used,
depending on what type, whether it is just the compliance or
just the compliance is
it's
quite
about
cheap.
25K or something.
25, okay. And the full duty
full
where
DD
we have,
is about a lakh or something, depending on how old the company is.
yeah.
Because if it is 2 or 3 years old and they're raising funds, there'll be a lot of documents to check.
Yeah, that's right. Then it becomes a little bit more expensive.
More expensive for time and effort.
Yeah. Okay.
So, sir, so as I understand it, so there are two types of due diligence, one from us and one from the investor, is it?
No, not this.
No. There's only one from the investor.
If it is from your own, they generally investor wouldn't take it because you, as your interested party, you can manipulate the DD, right? So generally, the DD due diligence is done by a guy whom the investor is also acceptable with.
Oh, so the due diligence, I pay for it or the investor pays for it?
No, you pay for it. The DD belongs to you because you can take it to anybody else and have the DD. But the investor should know that it was an unbiased DD.
Yeah. Oh, okay.
That's very critical.
Oh.
Yeah, now this whole space is very complex when it comes to large deals.
Yeah.
So I won't go into it. There's something called vendor due diligence. And that was my world when I ran the transactions group in PwC. But as far as a startup world is concerned, by and large, the investor commissions the duty. Right? You as the company may end up paying for it, but the investor commissions the duty.
So before I start my due diligence, I have to get the concurrence from you, right?
Yeah,
That
usually the investor will tell you, right? The investors often drive the due diligence process.
Yeah.
Because they're signing the check, no?
Okay.
The investment checks. See, if you take Kiretsu across the world, the members do the duty themselves.
Yeah, the non-compliance ones, right? Compliance ones, they often...
Compliance ones, they do it, the outside people do it. But generally, the other stuff, the members do it.
Okay. Now, I had a question. Is the duty done only by CAs? I think the compliance bit is done by CAs and company secretaries, but the market operational can be done by various things. I mean, there are CA firms that do it, but they often have other skills as well, because it's not just financial.
They generally have industry experts to do this.
Yeah. So someone who kind of understands the industry a bit is what we're looking for. If the DD is done once for a specific investor, can it be used? Of course. Yes. That's the whole point.
Because the DD is
you pay for it, you own it.
Yeah, you own the DD. So you can take it to any other investor and tell them. And generally investors, if you do a DD now and you go for a fundraise after 8 months or 10 months, some investors accept the latest DD which you have, so long as it's not too long of a gap. So, and since you are paid for it, it is your own DD. You can just give it to them and they will just take it. And then they will do the interim, the gap period DD if they want.
And the thing is, we are going from one angel group to another. Every angel group knows every other angel group.
Yeah.
Right? So by and large, we accept it, right? So there's very little that changes, right? Everybody's going to ask about the same questions, right? Most investors kind of know what are the questions that they're going to ask. So as long as all of that is covered, some of the missing pieces, they just do an interview and then they accept the duty. See, at the end of the day, the duty is only to help the investor make an informed decision, right? At the end of the day, all of us know that investing in startups is a high risk decision, right? The thing is, the idea is not to do everything blindly, right? In which case, why even bother, right? You can just spray and pray, right? But investing is not a spray and pray decision, right? It's a little bit of a informed decision, right? So that's what the duty is for, right? So no duty is going to be perfect. So by and large, as long as the key areas is covered, like the duty that SVK just shared, and people are kind of happy with it. Other questions? We've got 3 minutes. Okay. If not, Saurabh, Priya, I think we can close. We have a heavy session. Oh, someone put their hand. Arun, you put your hand up. Yeah, Arun.
Okay.
Yeah.
Okay. I have been listening to your sessions for the past 5 weeks. I have not heard about, I think, shall we apply for Kiretsu? I think it's say Kiretsu apply accepting startups for funding.
It does, yeah. So you can always apply to Kiretsu, and then there is a evaluation process before it comes up.
Yeah.
Right? There's a process that you go through.
We have a deal screening process where we have about 8 or 10 companies pitching in, and then we select 1 or 2 to be presented in the forum, which will be open for investments.
What is the deal
and
screening
even
process?
before the deal screening process, the staff will screen you.
We'll screen you.
Yeah, because they kind of know what our members like and what our members don't like. So there is a first level screening, and then the second level is the deal screening, which is a subset, a few people, and then before you get to the forum.
Okay,
So there's a process.
Can I get these details from the your website or?
No. Yeah, you can get it from the website. You can just.
Or you can apply to me, svk@kiretsuforum.com is fine.
Yeah.
I can forward. Mention that you're part of the Zoom series.
Super, I will do that. I will do that SVK, yeah. I am from Bangalore. That should be fine, right? I think anywhere from India.
Yeah, it's okay.
Yeah.
Okay.
Yeah. We have invested in Bangalore companies. We have invested in Delhi companies. We have invested in US companies. So
I will send it across to you, SVK. I will touch base with you later. Thank you. Yeah.
Okay, 2 minutes to 9 my time, 2 minutes to 7:30 your time. So Saurav, Priya,
sir.
you want to do a close and then prepare them for the last session, which is kind of heavy on valuations and transactions. Yeah.
Yes, sir. So thank you, Mr. Subra, and thank you, Mr. SVK, for another valuable session and enlightening us in detail on the various aspects of due diligence. So the next and the last session on the how to be investment ready series is on the 7th of September. The topic for the session is valuations and transaction documents.
Saurav, isn't it on the 8th?
Yeah, it's on the 8th.
Sorry,
Tuesday.
sir.
Yeah, it's on the 8th.
Okay, sorry. It's on the 8th of September. So thank you again, sir. Thank you so much. So before we sign off, I have a few announcements to make. So TiE Chennai's annual conference, TiECon Chennai, is planned from the October 5th to 10th, fully virtual this year. So we'll be having speakers for the English session as well as the Tamil session. The English session starts from 6 to 8, and we'll be having the Tamil sessions every day from 5 to 6. And we also have our first ever virtual Sunday, which we are opening, which will be open for all 6 days. And bookings are started. So I'll be giving my details. Members who are interested can sign in. So thank you all so much. Looking forward to your participation. Thank you.
Okay. Good night, everyone.
Good night, Subra.
Night. See you.
Bye. Good night, all. Bye.
Yeah, thank you.